I don't know what the prediction for this year is. I think the markets are mostly moving upwards for the short term. And then I think volatility is going to come back. I'm just trying to find So I think the real question for entrepreneurs is if you have the nth business, nth being not the first, not the second, but you're the seventh or eighth or 10th trying to go public, and all the 7 or 8 before you are gas guzzling machines, you're going to pay a very heavy price to get public. And I think that that's the reckoning that we're starting to see. So I'm really interested to see how that plays out. You know, the Instacart valuation could easily be cheap at 24, but it could just as easily be overpriced by another $10 billion, depending on how people think about who the last buyer of resort is in the public markets. When rates are zero, typically people are willing to pay 8 times revenue for a company. For every 100 basis point increase in rates, you decrease the valuation between 15 and 20%. So if you think rates are at 2.75%, the price is somewhere between 30 to 40% cheaper than what it was when rates were at zero. So if you go back and you look at every TechCrunch article and every Bloomberg article and every information article, and you look at all those headline valuations when rates were at zero, we all just said rates are going to be somewhere between 2.5 to 3% at the end of this year. At a minimum, you have to haircut those things by 30 to 40% steady state, meaning the company is continuing to execute on all cylinders. If they have a downtick in their performance, then it increases that discount. If rates go higher, it increases the discount. But the basic way to think about this is for every 100 basis point increase in rates, you got to downtick that valuation by 15 to 20%. Put a $10 billion price on the cover, and that, it effectively been cut in half. Again, these are all rumors, so these could completely not be true. I don't have any knowledge one way or the other, to $5 billion. And that may actually end up being too expensive. It just depends on where the market is. The problem is all of these financial services companies are essentially an arbitrage on rates, right? When rates are zero, they take that money at 0%, and then they can go and execute a business model, and sell that money at 1% and take the difference. But when their cost of capital is 2 or 2.5 or 3%, the whole business implodes on them. So you're going to see a bunch of these financial services companies get under pressure. Another example, Jason, is like all the low-end, bottoms-up SaaS companies. And the reason is because they spend their time inside of Google and Facebook doing customer acquisition and managing this very intricate dance of LTV to CAC. And when all of those input costs go up, their business implodes because you can't raise rates faster, or you can't raise prices faster than the input costs are. And then all of a sudden your unit economics blow up. And in all of this, what is the salvation in a moment like this? It's being healthy gross margins, healthy contribution margins, and a realistic path to profitability, which means being EBITDA positive this year or within the next 2 years. I don't know what the prediction for this year is. I think the markets are mostly moving upwards for the short term. And then I think volatility is going to come back. I'm just trying to find good long-term businesses and just kind of close my eyes and not have to look at these stock prices every day. And as long as I can manage my own psychology, I think I'll be fine. And I think that's probably the thing that most of us need to be doing. The interesting thing about Brad said is that the implication of that is that it means that late-stage venture is pretty badly mispriced. And I think you're going to have to knock these things back by 50, 60%. I think you saw the first real big movement there yesterday, which was the Instacart print, right? We went from a $40 billion valuation to, I think it was 24. If you look at from February of last year, which was really the high for all of us, right? That's when we all thought we could do no wrong. The comps to Instacart are off anywhere between 50 and 70%. Takeaway is off 70%, Uber's down 60%, DoorDash was down 55%. So these are some big moves. And so if you think about company building, this is why entrepreneurs have to pay attention to this stuff. You want to get money when money is cheap. But the problem is you can't control that timing. And so if you can't control your operating margins and your profitability, then you're going to have to go and basically pay somebody an enormously high price to get their money. And I think that's what's setting itself up to happen in a bunch of these markets. I think enterprise SaaS has always claimed long-term profitability. The thing is, when you look at sort of like the real long-term companies, they've built some enormous moats, right? Like if you look at a ServiceNow or a Salesforce at the high end. And then there's a crop of a couple of companies like Palo Alto Networks, who are the next ones coming after, who seem like behemoths in the making. But everybody else, I think people have to really question, like, where the long-term profitability going to come from? And so if that's true, then the late-stage private SaaS companies are in trouble. If you can't show that you're, to use the famous Paul Graham adage, default alive, in a moment like this, then you are a price taker, which means that you will have to pay probably a very high cost of capital to raise incremental capital to support a fundamentally fragile and non-resilient business model. Unless these private companies want to go dark for the next 3 to 5 years, meaning no sophisticated late-stage investor doing a round or going public, they'll be okay. But otherwise, they're going to have to reckon with a version of what Brad just said, which is the flight to quality problem. When in moments of uncertainty and high volatility, it's just more straightforward to go to the things that are reliable. And so, when you think in the public tech markets, what is a reliable must-own company? Well, I would put Snowflake in the list of these must-own high-growth software businesses, right? The FANGs tend to be in the must-own category. But then there are all these other businesses that then get orphaned because they're kind of nice to own, would love to own, would be great in any other circumstance. And that gets even more exacerbated in the private markets. You have to remember, right now, like, the private markets cannot really exist without an incremental buyer of equity. And the problem right now is that those folks have a lot more credible, safe, durable assets that they can own and not have to deal with all the crazy anxiety that comes with owning something that's high volatility. Any person can wake up tomorrow and buy the S&P index, right? What Buffett would tell you to do. Just buy the S&P 500 index. That historically has compounded at around 8% a year if you reinvest the dividends. So you can do nothing, right? Get a basket of the 500 best companies in the world that are automatically selected for you based on revenue and profitability. You don't have to do anything. And that'll compound at 8%. That is effectively the risk-free rate if you want to own an equity. So if you're going to step into the late stage private markets and, buy some shares in, dingdong.com, you got to be rewarded for that, which typically means that there's a premium above the 8%. And what Brad is saying, it's actually more than double. In his case, what he's saying is it's 2.5 times. You got to clear 20% to you. If everything is held equal, just with the rise of rates, you have to reset those valuations between probably 15 and 40%. Okay? At a minimum. But what Brad said is also true, which is if they then keep growing at a superior rate, they can get back to even. So meaning 18 months, they could also show up again at 40 and be net awash.
They could get unstuck.
But a lot of hard work will need to happen underneath the covers of these businesses in the next 2 years for that to happen. In order to grow revenue, you have to invest, right? You have to invest in salespeople, in account management functions, in engineers and product managers, right? And all of those people need to exist, which actually increases OpEx, right? It increases burn. It doesn't maintain burn. And so this is the death spiral, Jason, you're talking about, which is in order to actually grow by those multiples, you actually don't have
burn more fuel. You got to increase your speed.
You have to burn more fuel. You don't actually have the money to withstand 2 or 3 years.
Or the altitude. You're now.
And so it's going to be a very precarious balancing act of trying to figure out how these companies actually get to the other side. Because again, I think the buyers in this case will drive a hard bargain. Look, organizations like, Durable, D1, Tiger, Altimeter, these guys are the smartest of the smart. They're not dumb.
Yeah.
And so, the price of capital is going up in that case. And so, they're going to strike really good opportunities for their investors, right? And this time turns out is not really that much different. I think, Jason, if you take your list of these high-priced startups,
Yep.
I think it would be a good, useful exercise for somebody to do. Somebody in the press should probably do it. But if you take that list and just rank companies based on valuation, the last announced date,
Yep.
and then if they are not announcing layoffs of any kind, you can probably forecast when they're going to burn through the money, especially if they're hiring. And the reason that you can probably forecast that accurately is you can pretty much predict what OpEx will be, especially knowing the fact that their input costs are actually going up. So for example, most of these businesses that rely on Facebook and Google and Instagram for customer acquisition, those input costs are going up. And the reason you know that is that's $2 trillion of market cap that doesn't give a flying fuck what's happening in startup land. They're going to make their numbers.
Right.
Okay. Those are the most important companies in the world. They will ratchet up the prices. And so your input costs are going up. It's not just the physical supply of materials that I think is going up. It's just the cost of customer acquisition is going to probably go up by 20, 30, 40%, right? And you know this because Facebook and Google guide to where they need to perform. And so if you pass that through the venture ecosystem, that all of a sudden now upticks your burn.
Yep.
If you're adding more people, it upticks your burn.
Yep.
And now back to David's math, you then also have to grow 5 or 6x. None of this hangs together. So we are at the beginning of probably a very complicated process of unwinding the distortion that we've lived through in the last couple of years. The number of qualified investors have gone way down as the surface area of investing has gone way up. So again, just going back to this conversation, this woman is staffing most of these venture firms with their junior and mid-level partners. And again, the qualification to become a venture capitalist at this point is not that you have an ability to pick or, in David's case, have operated and actually run a business and then actually have developed a methodical framework, or Brad's business, which is Brad had to start from literally zero in the public markets and work his way backwards to end up with 15 or 20 billion of assets. It's none of that. It's, are you a VP at an XYZ unicorn that may also be poorly run? And all of a sudden that, gives you the qualification to go into a job where, and it's not their fault, where what they are told is what you want is what we're going to give you, which is the ability to write, X number of checks per year. That is insanity. That's not what makes a good investor. And then your ability to then give advice, I don't know, it's probably zero or less than zero. I actually think what I am is an investor.
Right.
But you don't have LPs for a VC fund like Sachs and I do.
But this is my point. Like, I think investing, irrespective of whatever stage you do it, still fundamentally comes down to the following, which is, do you have the judgment to understand whether these decisions are marginally good, marginally average, or marginally destructive for the short, medium, and long term of a business? And I just don't think that enough people steep themselves in the practice that it takes to get good at that kind of a game. And I think what these moments expose is that the status games that come around investing, because it just seems like it's easy, it just seems like you don't do much work, that's what ruins these periods. And the implications, I think, as Brad said, is really right. It affects the employees, it affects the entrepreneurs, it affects the startup culture, it affects the incremental desire for people to take a shot at things. You can overcome all of it. We have, and we will again. But I really think, like, to the entrepreneur, the message is, if you're, taking a term sheet, I think you have to have better judgment to really look at that investor and say, is this person really qualified to help me? Because in these moments, in the absence of help, you're probably going to basically have a valuation reset at the minimum case, and the worst case is you go out of business.